Good morning. This is Nick Stern with Robert L. Stern Financial Services. Hope you're doing well. Thanks for tuning in. Just going to take a seat here. So, it's been kind of a crazy winter so far. It's definitely probably one of the colder ones up front. Anyway, I just hit the range yesterday. Today's Monday. And it was in the 50s or high 40s yesterday, so super pumped about that. And not that you really want to hear about that. Anyway, so 2018, I wanted to do a bit of an investor series, getting back to basics as far as the overall financial markets, what you have available to you. And I talked about an overview of the financial markets and just some terms that people refer to when talking about the financial markets and investing, etc. So I'm going to get a little bit more specific today, and I'm going to talk about mutual funds. Mutual funds are a very common investment that you'll probably see in your 401k, 403b, simple plan, maybe even your IRA. They're very common, and they're a way to invest to capture the performance or ups and downs of the financial markets. What mutual funds allow you to do, and this is my own definition, is they really allow you to not put all your eggs in one basket in regards to investing in the financial markets. So there are a ton of mutual funds available out there to you. You might be limited in a retirement plan like a 401k because there's only a certain list that the retirement plan has available to you. But just in general, if you were investing in, let's say, through your own IRA, through a brokerage firm, you would most likely have availability to quite a bit of these mutual funds. And mutual funds, when you buy a share or shares of mutual funds, those shares are representing ownership in a lot of different companies. So let's say you're going to buy a mutual fund that's an index fund that it says mutual, just for illustrative purposes, mutual fund S&P 500 index. So what you're doing when you buy that fund or when you buy into those shares of that mutual fund, that's basically going to represent the S&P 500. We had talked about what the Standard & Poor's 500 index is in the previous video. So you're buying into that mutual fund, and that mutual fund is more or less going to mimic the performance of the S&P 500. And the reason why it does is it's going to try to mimic how the S&P 500 is weighted with all the different stocks and stocks that are in there that represent the companies. So however the S&P 500 is going to be weighted, and when I refer to weighting, I mean that the S&P 500 has 500 companies or so in there, and how the weighting is how those companies' stocks make up the index. So the mutual fund that you're buying that's going to represent that is going to be invested in basically the same allocation. Of course, there's always going to be an expense ratio in a mutual fund. In an index fund, it's going to be pretty low because there's not a whole lot of quote-unquote active management. And we'll get into that in a second. So that's a really simple way to conceptualize a mutual fund, and why you probably have heard so many people are saying, well, just buy an index fund, just buy an index fund. Another type of mutual fund that is the same concept but going to be potentially different from the index could be what's called an actively managed fund. And to distinguish the two, an actively managed fund, when you buy into a mutual fund that is an actively managed fund, You are buying a fund that has a fund manager, somebody or some buddies that oversee how the dollars that are being invested in their fund are being allocated. So, for example, to distinguish that S&P 500 index fund, there's no real management, because all that the fund managers are doing is making sure the fund mimics the S&P 500. In the let's just say it's the actively managed mutual fund, we'll just call it that, they have a benchmark, and maybe that benchmark is the S&P 500 index. And what the benchmark is designed to do is give you, and them of course, but mainly you as an investor, to see how they're doing in respect to the benchmark. So for example, if the benchmark returns 10%, and the fund, which is 100% invested in stocks, returns 12%, that means that that fund beat its benchmark. So I don't know if you've heard this term or not, but that means that they're adding 200 basis points or 2% of alpha, meaning the alpha represents how much the fund manager is adding value to your investments over and above the benchmark. Does that make sense? I hope it does. That's a simple way to think about it. So when you are looking at funds and you see a fund has a very high alpha, that means that the manager is adding a good value to the fund over and above the benchmark. So let's get back to actively managed. How it's going to work is the benchmark is the S&P 500, and the fund manager isn't necessarily going to be equal weighted or weighted the same as the S&P 500 fund. And they shouldn't, because the actively managed fund is always going to be more expensive than the index fund. So here's where fees come into play, where you want to make sure that you're getting as much bang for your buck. And the managers are supposed to basically be worth that added expense. Now, granted, the added expense could be minimal, but still, you still want to make sure that there's value there. So, and there's a lot of different ways to analyze adding value. And even if it's not necessarily, it's not always predicated on performance, where they always have to beat the benchmark. Another way to think about it is on a risk-adjusted basis. So when we're analyzing risk of funds, and let's just say standard deviation, which is a very traditional measure of risk, is 15, just for illustrative purposes, on the index fund. And the actively managed fund is 13. So the higher the number, the higher the risk. So if both funds perform the same, but the actively managed fund is getting the same amount of return with less risk, that's a way that a fund manager can add value to your investments. It doesn't always need to necessarily beat the index or its benchmark to add value. It also has to do, like I said, on a risk-adjusted basis. So when you're looking at various funds, don't just look at those type of numbers. If you're doing your own analysis, also look into the risk profile. The risk, think about it, risk reward. Obviously, everybody wants the maximum amount of reward with the least amount of risk, but there has to be some sort of trade-off. So at some point, when you're taking the amount of risk that you are, of course, you want the reward to be more than the risk that you're taking, but at some point, there's a break-even point, and then as you go on, there's basically too much risk given the amount of reward, which is not good. And again, back to the underlying value of the active manager, or potential value, is their fund is going to look different, or it's going to be different weighted, and they're doing their own analysis. And what you're saying by buying that is, we believe in the fund manager or managers that they're going to be able to add that value, whether or not it's on a risk adjusted basis, or we think that based on their analysis, they know something different than the market, or however they analyze companies, or their research dictates that it makes sense to use them over an S&P 500 fund. In particular, I'll say that in a general statement, when it comes to passive index funds versus active managed funds, when the overall general markets are going up in a really meaningful way, it begins to be, and I want to add to that, when there's less volatility, there's not a lot of volatility, the indexes can be a positive investment if you have that risk profile. But remember, you're going to catch all the volatility one way or another. So active management can have a harder time when the markets, as a broad index like the S&P 500, are going up and there's very little volatility. But when there's more volatility, let's say this. I'll give you an example. The S&P 500, this is purely hypothetical, illustrative purposes. Let's say the S&P 500 over year 20x1 returns 15%. And that's at the end of the year, the S&P 500 returned 15%. And let's say during that year, there was no market swings up or down more than 3% in any given day or short-term period. I'll define short-term period as a month. Basically, the 15% happened by just a steady and consistent return with very little major ups and downs during the time period. Let's take year 20x2. The S&P 500, purely hypothetical, is, and I have to say that for compliance, but it is hypothetical, returns the same 15%. But during the year, there was one or two time periods where there was extreme volatility and the market went way up, and then it came back down, and there was points where the market was down 10%. And there was several periods in there where there were big swings up and big swings down. But in the end, if you're just looking at year to year, the market still returned 15%. In the first scenario, where there's very little volatility and it was just a steady, consistent rise with pretty much no meaningful ups and downs, the passive fund may in fact look better on paper, or it might perform better because if you own it from on day one of 20x1 and you're just getting the same performance through, and you're going to return 15%. Maybe that same active management fund in that year returns 12%. Well, why if it's doing that? And that's because it's not going to mimic the exact performance of the S&P 500. And maybe they had more conviction in certain areas of the market over being so broadly based like the passive fund, which can cause underperformance or in some cases overperformance. Similar in the second year where there's more volatility, maybe now the passive fund, of course, we know is going to return 15%, but maybe the active fund returns 17%. Well, why is that? Similar to the first scenario where the active manager has the ability to be more nimble to some degree, and maybe the areas of the market that got or were more volatile during that year, the fund manager or managers didn't own. So they didn't experience the same volatility. So that's how And that's usually where in periods of volatility, more active management can be better. It's not always the same case. Or let me rephrase, not be better, but it can have more positive performance. And also, that's where the fund manager could add that alpha or add the same performance on a risk-adjusted basis. Because if they're, again, in that same volatile year, let's say the funds return the exact same, well, during that time period, if you own the S&P 500 fund, you're going to mimic those big swings in the market. But let's say mid-year in the active management fund, instead of being down 10, you're only down 5. Well, that's because they're going to be owning different securities. And they're going to be invested in whatever they think is going to do better or not do as bad, and that's where that active management and on a risk-adjusted basis is going to come into play. There's, of course, always stipulations in actively managed funds, so there's potential limits in what they can do, but I would just say when thinking about mutual funds, think about how they're invested, risk-reward, alpha, of course, expense ratios. Don't just look at total return or overlying performance. If you have any questions, please feel free to call in, email in, what have you, no obligation. Hope this has been helpful, and I will see you